OPEC Plus agrees to larger than expected oil production hike in August. OPEC Plus surprises markets with 548,000 bpd output hike in August, oil prices tumble. OPEC Plus agrees to larger than expected oil production hike in August. This decision shocks the oil world. 8 of OPEC Plus's biggest players have just agreed to ramp up daily crude output by a whopping 548,000 barrels in August, far exceeding the 411,000 barrel increase everyone anticipated. And this is the part most people miss. They're pulling back even more of the voluntary cuts they once swore would stabilize prices. In a virtual meeting on Saturday, Russia and Saudi Arabia joined forces with Algeria, Iraq, Kazakhstan, Kuwait, Oman and the United Arab Emirates to deliver this surprise boost. The alliance says the move reflects a steady global economic outlook and rock-solid market fundamentals, including historically low oil inventories. But here's where it gets controversial. Are they prioritizing market share over price discipline? And what does that mean for consumers and rival producers? How did we get here? Since the start of these special OPEC Plus measures, these 8 nations have enforced 2 separate voluntary cutbacks. First, they pledged 1.66 million barrels per day in cuts through the end of next year. Second, they carved out another 2.2 million barrels per day until the close of the first quarter. Originally, they planned a modest 137,000 barrel monthly production uptick through September 2026, but that pace stalled after April. Then came a sudden acceleration, 411,000 barrels per day in May, June and July, each month. Now, in August, they've nearly doubled that monthly hike. The stated rationale: healthy supply-demand dynamics and confidence in continued economic growth. Critics counter that this aggressive unwinding could spark a price war, squeeze smaller producers, and undermine long-term revenue for OPEC Plus members themselves. Recent weeks saw oil futures get a seasonal boost from summer travel and a brief flare-up in the Israel-Iran conflict. That 12-day confrontation threatened supplies from Tehran and raised alarms over potential disruptions in the Strait of Hormuz. By Friday's close, September Brent was trading at $68.30 per barrel, while August U.S. West Texas Intermediate settled at $66.50. But here's the question on everyone's mind. Is this bold strategy a savvy move to capture market share as demand recovers, or a dangerous gamble that could ignite fresh volatility? Do you think OPEC Plus has struck the right balance, or are they playing with fire? Share your thoughts below and join the debate. OPEC Plus surprises markets with 548,000 bpd output hike in August, oil prices tumble. Imagine a world where oil prices are tumbling, driven by unexpected decisions from the global energy cartel. This is exactly what happened recently when OPEC Plus made a bold move to hike production more than markets anticipated for August. But here's where it gets controversial. While some see this as a sign of confidence in global demand, others worry about the potential ripple effects on economies worldwide. What does this mean for everyday consumers and businesses? Let's dive in and explore. On Monday, oil prices took a noticeable dip after OPEC Plus, the alliance of oil-producing nations, announced a larger-than-expected production increase of 548,000 barrels per day, BPD, starting in August. To put that into perspective, this marks a significant jump from the 411,000 bpd hikes approved for May, June, and July, and even surpasses the modest 138,000 bpd boost seen back in April. By August, nearly 80% of the voluntary cuts, totaling 2.2 million bpd, that 8 OPEC producers had implemented earlier will be reversed, according to analysts at RBC Capital led by Helena Croft. But hold on, there's a twist. Despite the ambitious plan, actual output increases have fallen short of expectations so far. Most of the additional supply has come from Saudi Arabia, which has been aggressively ramping up its production levels. In fact, in a clear vote of confidence for Asian demand, the kingdom raised the price of its flagship Arab light crude to a 4-month high for deliveries to Asia in August. It's moves like these that make you wonder, is OPEC Plus playing a long game here, or simply responding to immediate pressures? Adding another layer of complexity, Goldman Sachs analysts predict that OPEC Plus will announce yet another substantial production increase of 550,000 bpd for September during their next meeting on August 3. If true, This could further weigh on oil prices unless demand surges unexpectedly. And this is the part most people miss. While higher production might seem beneficial for consumers due to lower fuel costs, it can also signal underlying concerns about economic stability if demand doesn't keep pace. Now let's talk about tariffs, a topic that continues to dominate headlines. Oil markets were already jittery over uncertainty surrounding U.S. trade policies, particularly with regards to new tariffs set to take effect on August 1st. Originally announced by then-President Donald Trump in April, these tariffs included a base rate of 10% on most countries, with reciprocal rates climbing as high as 50%. However, recent comments from Trump added confusion, suggesting that tariff values could range anywhere from 10% to an eye-watering 70%. The lack of clarity has left traders uneasy, exacerbating volatility in an already fragile market. According to Priyanka Sachdeva, a senior market analyst at Philip Nova, concerns over Trump's tariff strategy remain a dominant theme heading into the second half of 2025. She noted that dollar weakness currently provides the only lifeline for oil prices amidst growing uncertainties. So, how much should we read into this? Are we witnessing the beginning of a prolonged downturn, or is this just a temporary blip? Here's a thought-provoking question for you. Do you think OPEC Plus's decision to flood the market with extra barrels is a strategic masterstroke or a risky gamble? Does it reflect confidence in robust future demand, or is it a desperate attempt to maintain market share amid geopolitical tensions? Share your thoughts in the comments below. We'd love to hear what you think. In summary, Brent crude futures dropped by 47 cents, or 0.69%, settling at $67.83 per barrel by early morning GMT, while U.S. West Texas Intermediate, WTI, crude slid by 95 cents, or 1.42%, to $66.05. These declines underscore the ongoing tug-of-war between supply, demand, and policy decisions shaping the energy landscape today.